Hello, we are Ryan Cohagen, Aaron Rigsby, Curtis Simmons, and Hamilton Wise of the Broken Road Reports. This year, we're following Eastgroup Properties. Eastgroup Properties is followed under the New York Stock Exchange. We gave them a rating of market perform and a target price of $67. Our agenda for today is to go over the rating and performance, the investment thesis, the valuation methods, the REIT industry as a whole, the REIT peers that compete directly with Eastgroup, a company analysis, and finally the risks and conclusions that we can draw from all of this. First, I would like to draw your attention to a graph. This is Eastgroup's stock performance over the past several years. As we can see, there has been a general upward trend, finally culminating in a price of $61.43 as of the time of this report. Now we have four investment theses. First, Eastgroup has increased occupancy rates for each of the past 3 years. Second, focus on development in the Sunbelt states has yielded consistent growth for the entire Eastgroup company. Next, recovering economic factors lead to increased demand for industrial real estate. Lastly, a potential interest rate hikes in mid-2015 could increase acquisition costs as well as slow growth. The valuation method we had decided to use relied on three primary factors to drive revenue. The first was the price, the second, the square footage, and last, the occupancy rate. Multiplying the price per square foot, the total number of square feet, and holding the occupancy rate steady, we achieved a top-line revenue that we could then use to dial in our forecast more accurately. The graph to the left shows that the expenditures were linearly related to the amount of square feet that Eastgroup was able to acquire throughout the entire history of the company. Next, the graph shows that since 2011, the occupancy rate has continued to increase. Now, because it has continued to increase, and because it cannot exceed 100%, we held it steady at 95% throughout our entire evaluation. Lastly, we would like to show that investments in different areas have been steady and disperse throughout the entirety of the Sunbelt region. Although Texas has seen large investments, Arizona, California, and Florida have not been left out. For the valuation of our REIT, we elected to use the FFO multiple and the DCF valuation. Traditionally, a net asset value is used. However, we believe that this is inferior because it only accounts for the book value of the assets and not the future cash flows that these assets can derive. The FFO multiple, however, takes into account future cash flows per share. The DCF valuation likewise takes into account future cash flows and discounts them at an appropriate rate. Both of these methodologies give a share price which is more in line with the actual valuation of the company, especially for firms which invest in REITs. These firms are traditionally concerned with future valuation and future cash flows through dividends rather than the actual valuation of the book value of the company. Combining these two valuation methods, we achieve a target 12-month price of $67, which is up from its current price of $61.43. So what is an REIT, or a REIT? 75% of the revenues must be derived from real estate. 90% of their taxable income must be paid out as dividends. As a benefit for abiding by all of the rules, REITs do not pay corporate taxes. REIT investments basically act as mutual funds for real estate. They pay reliable dividends, and they offer financial transparency not otherwise offered. Lastly, they are some of the quickest to recover after economic downturns. Looking at the REIT industry as a whole, we find that annual revenues recover quickly after all economic downturns. Yearly revenue for REITs in 2014, for instance, was $141 billion. Industrial REITs have several advantages over other REIT forms. For instance, they are more stable, require less capital to get running initially and have a flexible use of space. These are things which retail REITs or office space or medical REITs do not have the luxury of. Next, I would like to address the REIT industry as a whole. The revenue sources are from development of new properties, acquiring old properties and charging rent on them, or selling current properties and using that funds to either be dispersed to shareholders or invest in new property. Several economic factors can affect REITs. Increasing vacancy rates decrease REIT value. As per capita income rises, REITs are able to charge a premium on rental space. As land value increase, rental rates also increase. However, land value increases acquisition costs for REITs. Locations link a REIT to a particular economic climate, which can either be good or bad. Lastly, land availability is inverse of what a REIT would like. The more in demand an area is, the less available the land. Contrary, the more available land, the less desirable the location. This increases the barrier to entry for an established REIT. However, entering a new market, especially seeking an infill location, becomes difficult. Next, I would like to take a look at the REIT peer analysis. Here we have Prologis DCT Industrial Trust, Terreno Realty, as well as Monmouth Real Estate Investment Trust. Now, I have highlighted an orange square on the bottom. This is the 2014 FFO, or Funds from Operation. As we can see, at 3.47, Eastgroup Properties is the greatest, or it has the greatest funds from operations going to the shareholders per stock. Next, I would like to highlight the return on equity investment. At 0.08, it is nearly double the amount that the nearest competitor holds. Eastgroup Properties is based in Jackson, Mississippi. It operates as an industrial REIT. It has a portfolio of what are called destination distribution centers. When something is shipped somewhere, it ends up in one of these warehouses and then is shipped to the city itself. They have triple net leasing agreements, where tenants are expected to take care of all of the costs associated with the property, as well as paying a flat rental fee. Lastly, there are low building costs associated with building industrial real estate projects. The company's strategy relies on 4 key pillars. Industrial warehouses, as shown in the pictures to the sides of this slide, are generally simple, easy to build, and very, very flexible, affording all sorts of consumers opportunities to rent. Next, they have a Sunbelt location preference. As shown in the map below, we see the size of the circles relating to the size of square feet in each particular city. There is a strong concentration of warehouses all across the Sunbelt region of America. Clustering all of these warehouses together on a single plane, we can see that Eastgroup Properties is heavily invested in Houston. Eastgroup Properties also focuses on a low debt financing by maintaining an optimal ratio of 35% debt to market equity. By maintaining a debt-to-equity ratio of 35%, Eastgroup Properties remains more flexible than their competition and is better able to take advantage of opportunities as they come up. Lastly, the company focuses on infill locations. Although this map is a little bit zoomed out, I wanted to show the locations in relation to the Beltway, or the highway circling Houston. As we can see, Houston extends broadly. However, the majority of the circles are clustered around the middle band of Houston. This is an infill location, or somewhere that has already been built up. These spaces that have already been built up are able to charge a market premium, and because demand is so high, any dips in demand do not actually affect infill locations as much as they affect the outlying areas. For risk analysis, we divide the risk into 3 silos: operational, regulatory, and financial. Under operational, we need to realize that lease demands are linked to the local economies. Because we cannot move the real estate, they are beholden to the local economies, and as such, any boom or bust locally will adversely or beneficially affect Eastgroup. Insurance policies, of course, manage to dampen out some of these economic changes. Regulatory risks can also have an effect. Zoning and building regulations could lead to increased expenses. A change in the REIT tax code will also change the entirety of the REIT industry. Finally, financial risks. The expected interest rate hike at the end of this year could decrease the lending availability to REITs as a whole. Combining this with the less liquid holdings of any sort of real estate holding company reduces the responsiveness to any sort of economic changes in conditions. In conclusion, our 12-month target price is $67. We give them a market rating of market perform. We believe Eastgroup has several competitive advantages over their peer group. We also believe Eastgroup has gone to great lengths to minimize as many risks as possible. The Brooklyn Road Reports are produced solely as a part of an educational program at Tulane A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you.